Welcome to what, in my view, is one of the most important discussions that's going to be going on at this conference. I'm delighted to see so many of you here for it. We've got a treat in store because we have an excellent panel, all very well versed in the issues we're going to be discussing. This is, of course, a huge subject. You'll be familiar, no doubt, with green bonds, which have attracted so much attention in the capital markets world to the relevance of the environment and beyond that, sustainable development in society to what we do in the financing and investing world. But we're going to be talking about that and some of the broader issues around that. Just to set the scene, I think there's been an incredible change since we were here last year. The sustainable finance agenda is speeding up all over the world. We've had developments like the European Commission's Sustainable Finance Action Plan, a very major set of proposed legislation that was simply nowhere on the scene 18 months ago. The Task Force on Climate-Related Financial Disclosures, which is going to try to encourage all securities issuers and investors to disclose how they are thinking about climate change and its relevance to their business. And even central banks starting to study the climate risk embedded in the financial system. Yet at the same time, the financial system we see around us remains essentially the same as it has always been. A lot of dirty, polluting companies and activities are still going on. We're still investing in them. Our own pensions and savings are going into them. The oceans are still being chucked full of plastic, and we're running out of time to keep the global temperature to a livable level. It's probably already too late to avoid damaging climate change. So in the context of that, the challenge for us as financial specialists is high. There's a lot of thinking to be done. So to give you some insights on some of the leading edge thinking in this area, and also give you an opportunity to ask any questions you may like to ask, we have a great panel here today. I am singularly ungifted with technology, so I'm going to ask, if you'd like to ask a question, can we do it the old style way? Just put up your hand, and we'll do it low tech. I'll give you a couple of opportunities to do that, but get your questions sharp. So just to begin with, I'm going to ask the panel to introduce themselves briefly and just say what each of them does and their involvement in the issue of sustainable finance. So starting with Zamir.
Thank you, John. Zamir Iqbal. I'm VP Finance and CFO for Islamic Development Bank. Islamic Development Bank is a multilateral development bank having a membership of 57 member countries, all the Muslim countries. And we are about 45 years old. We have quite an active issuance program, something called Islamic bond or Sukuk, which we use. We have our annual issuance of about 4 billion, and Sukuk has some of the embedded features of what you call it a sustainable development or the sustainable finance.
I'm Kochetygova. My role is Senior Sustainable Investing Research Analyst at Northern Trust Asset Management. So I represent private sector here. Northern Trust Asset Management has in excess of $1 trillion under management. And we have a long story of sustainable investing, more than 30 years. And at the moment, we have more than $80 billion invested in various ESG or sustainable strategies and products. Most of them are equity products, but just recently this year we launched 3 different strategies in fixed income linked to the ESG records of issuers, combining ESG records with low carbon credentials, and also adding quality and value as investment factors.
Thank you, Julia. Alvaro.
Thank you, John. Sorry. Thank you, John. So I'm Alvaro Lario. I'm the Chief Financial Officer of IFAD. IFAD is a UN agency and an international financial institution. We provide sovereign loans to different countries, especially on the less developed countries, and we focus a lot on impact investing.
And that's the International Fund for Agricultural Development.
Correct, yeah. So right now, for example, we're putting together a fund on the private capital markets to address impact investing, especially on the rural areas. And that's and we're obviously very focused on the Sustainable Development Goals. Number 1 on poverty, number 2 on hunger, and others. Thank you.
Thank you.
So my name is Heike Reichelt. I head the investor relations team at the World Bank. And the World Bank is, I'm realizing, the oldest kid on this block. The World Bank is owned by 189 shareholders. And we have been in the capital markets for over 70 years now, mobilizing private sector financing for development. So we issue about $50 billion in bonds every year to finance our sustainable development projects in our middle income borrowing members. A very exciting new development this year was that at the World Bank Treasury, we are also responsible for the funding program of the International Development Association, IDA, which launched its very first bond in the capital markets in April this year. And IDA works to provide financing to lower income countries around the world, always with the goal of eradicating extreme poverty and boosting shared prosperity. So that's our mission.
Thank you.
I'm Irene Sáchez. I'm head of investor relations in European Investment Bank. EIB is the bank of the EU, so it's owned by the 28 member states of the European Union, and therefore the bank has the mission to serve the policy goals of the EU. Among these policy objectives, climate action is key, and EIB has been therefore active in the capital markets also to serve the climate action goals. EIB has a funding program of around 60 billion euro for this year, and in terms of green bonds, EIB pioneered it in 2007 with the first issue there, and we've issued since then around 23 billion euros in climate awareness bonds. News for this year is the launch of a sustainable awareness bond that has been announced in order to enlarge a bit the sectors that we cover in line with the EC action plan, which is prompting for more sustainability of the financial system. And you will get more news on this as the autumn comes by, but expected launches around more or less after the summer.
Thank you. Okay, so I'm going to start by asking the panel, bearing in mind what I said earlier on about a lot of activity in sustainable finance, but also a lot of dirty, polluting stuff still going on, do the panel believe the financial system has actually started down the track it will need to follow to reach a sustainable economy? Zamir.
I think the answer is definitely yes, but I think the road ahead is quite uphill and it's very challenging. I think we are touching the tip of the iceberg because if you look at if you really want to make the financial system as a very pro-development or pro-sustainability, I think it needs a lot of work which needs to be done. And I think realization is there. Part of it is many efforts taken by G20 as well, which is looking at how to make the financial system as a more sustainability friendly. Similarly, I was on a panel in the UN last week, and the whole discussion was precisely on the topic that how do we make the financial system, which has all the many stakeholders, private sector, public sector, becoming more awareness of how to develop this sustainability-friendly financial systems. Because the challenges which we are facing, especially in our member countries, which is some of the very poor countries from Africa and Asia, we have a very weak financial sector. So the whole point is that not only to strengthen the financial sector, and then on top of it, making them aware about how to make it more responsible and sustainable. So certainly, I think the answer to your question is that, yes, there is an increasing awareness of making the financial system more friendly with the sustainable economy. However, the task is quite challenging. It will take a lot of effort, but we have to start somewhere.
Thank you. Julia, you mentioned $1 trillion of assets 80 billion are ESG managed. Do we need to get that 80 up from 8% of the total to 80%, or how's that going to work?
I think we would all like to see the private investors or all investments being sustainable, so that we can fully, with full confidence, speak about mainstreaming of sustainable investment. Unfortunately, this is not yet happening, even though sometimes optimistic numbers say that 50% or even more of all managed assets are managed versus some kind of sustainability criteria, whether it's mild, like excluding some stocks or bonds, or it's more advanced, like best-in-class selection. It's a big question. What I can see from my perspective is that when we get RFPs for new mandates, these are increasingly incorporating sustainability criteria. So pretty much, in Europe, we're actually getting 90% of new money into our sustainability funds. We have 10 funds that we manage in EMEA, and in those funds we have 19 billion now. So again, as a proportion of the overall, it may seem small, but in terms of the dynamics, in terms of having started with a low base and achieved this type of pace of growth, I think it's quite impressive. We definitely still need more investment products in this area, particularly in the fixed income space, because in the fixed income space, compared to total passive products, sustainable are just 3% in Europe. It's very small. The fixed income as an asset class is catching up with equity, but I think that with a couple of years of gap, it is still moving in the same direction.
Thank you. Alvaro, do you see any encouraging signs, or?
Well, I think the question that you framed to me, I always get confused on what it means, the financial system to be sustainable or not, or what we are. I think the main goal is to channel the savings of all the big capitals, including pension funds and so on, into what is needed for us in the development world, and how to make more sustainable economy. So in that sense, I think we need to ask investors what are they looking for. And I would say that there's also some different confusions between ESG, SRI, SDGs, impact investing, social investing. So there are many terms that at this stage I think green. So if we look at the different asset classes on the equity space, clearly it has been a success, the ESG investing. I think there's more and more type of funds, and when equity looks at ESG, what are they looking at? Not normally at the environmental, not normally at the social, but mostly at the governance. So I would say that governance is what they focus on. It has been really addressed through research, that it's one of the main drivers that can give you higher returns. In terms of the fixed income, which is what we are addressing today, perhaps we have been focusing a lot on the green side, which is a way of trying to just manage a pool of projects, of green projects, and how to fund them. And generally on the impact investing, which is another topic that might be much smaller in the hundreds of billions, that's a different story too, because you need risk-adjusted returns there, and at the same time you need products and services that are directly measurable and which have an impact on the lives of the poor. So it's also a very different sector than when we're talking about ESG. So I think it's important to differentiate, and what's the goal of all of this? Probably it's risk-adjusted return for a certain type of risk, but just to try to be very clear on what we are trying to address.
Okay, Heike, Alvaro's talked about the different sort of categories or ways of talking about responsible investing. Do you agree with the way that he's described them, or?
So yesterday there was a panel on ESG 2.0, which means that there has been a panel on ESG 1.0 already at this conference. Which I think is an encouraging sign. So that's starting to permeate the sort of regular mainstream conferences. And on that panel, there were two investors who were asked sort of the same question. And one investor said, well, SRI, ESG, impact, basically it's just about us as investors wanting to put our money into something that has purpose, that has a sustainable purpose. And he said, these are his words, not mine, make an honest buck doing that. So I guess that would be sort of the risk-adjusted, looking for sustainable investments overall approach. And another investor said something that was very easy to remember. He said, SRI, ESG, or impact, you can think of that as A, B, C, and a continuum. SRI, socially responsible investing, is about avoiding, so doing no harm, exclusion, looking for investments that exclude certain things, but assessing them for what they do. ESG, B, is about benefiting stakeholders. So it's about looking at companies' environmental, social, and governance aspects, but looking at them sort of as a corporate, checking for risks that might affect the price of the investment. And then impact, C, is about looking for things that make a contribution to society. And I think what's interesting is that in fixed income, the excitement around labeled bonds is that it focuses on this C around this impact. So investors are looking to be more connected with the purpose of their investment, and they want information about impact. The Sustainable Development Goals provide a nice framework for investors with nice colorful boxes that they can then look behind to see what metrics are in them and provide a framework to their investing that is about measuring the impact. Now, I really think that we are in early stages of this, so it is the end of the beginning, maybe, but there's still a long journey ahead of us, and it is an evolution. I mean, this transformation in the capital markets isn't happening overnight, even if it's decades already in the making. But it's accelerating. And the Sustainable Development Goals and impact and transparency, I think, is a great development that's helping catalyze it.
Thank you. Irene, Heike's talked about the process accelerating. I think we can all feel that, but is it accelerating fast enough from where you're sitting?
Well, there are a lot of things happening, definitely, which doesn't mean that a lot more doesn't need to happen, obviously. But if we look at the changes, maybe just from the last year, they're just amazing. I mean, the amount of issuers that have come into the space, predominantly sovereign issuers, it's just phenomenal. And I think these sovereign issuers, multilateral development banks, we do have a role, so to say, to lead with example and explain why this impact and transparency is important in order to encourage more the private sector to come into play. I would second Heike's views in the sense that impact is probably one of those areas where investors are becoming more and more focused. At least we do get a lot of questions on impact reporting from investors, and we do engage into conversations to explain why we calculate things one way or the other way. So when we look now a bit going forward and the challenges that need to happen, we are focusing mostly, let's say, on transparency. Transparency not only on the eligibility criteria, we can talk about that a bit later with the opportunities that the EC regulation is going to present, but also in terms of reporting indicators. I mean, if we look, last year there was the AGM of the GBP held in Hong Kong, and there it was presented, let's say, harmonized methodology for calculating reporting indicators for the social space. I mean, this would have been unthinkable a year ago. I mean, it's complicated. Everyone says it's complicated. Definitely is, because it's more a blurry area and it's a bit more local focus than the pure climate space, but we're getting there. So there's definitely a lot that's going on, and that's a good sign of the market maturing and global and encompassing every time more and more sectors.
And I don't know whether we might be able to do something about that noise, but when you're, obviously there are green bonds, there are social bonds and so on, but there is also just bonds. And all of the organizations in the capital markets have to issue debt, one kind or another. Do you find that when you go out to investors seeking to raise money, they care about the mission of the organization, the ESG credentials, or not. Heike, do you want to take that first?
Sure. So the financial characteristics are still sort of the most important. And so when we go to see investors, they're looking for safety, liquidity, but increasingly they definitely are more interested in what we do with the money. So the dialogue is changing, and it's really important that investors have a story about that. And when people say that they're looking for sustainable products, I think they need to look beyond labels and go beyond the sort of old ticking boxes approach, but really understand the mission of an issuer and the approach, the due diligence approach. And of course, multilateral development banks like the World Bank, long before we issued the first green bond, we were issuing bonds that supported a sustainable development that were focused on health, on education, on environment. And this is something that's becoming of more and more interest. And the reporting that Irene mentioned is an important factor. But harmonizing this is really challenging. And I think that sort of data is going to be a really big and important evolution in this market. But at the end of the day, sustainability is about judgment. And so sort of the old way of looking only at numbers and quantitative is going to be challenging. It really has to change.
Okay, thank you. I think I want to move on to talk about government action. Now, there's obviously, especially in Europe, but not only in Europe, there are very major efforts going on to make the financial system more sustainable. They're at quite an early stage, but they are quite strong. In particular, in Europe, we've got laws coming that are going to state that it's part of investors' fiduciary duty to their clients that they consider environmental, social, and governance issues. Now, not long ago, you'd hear investors saying, we can't do that because we've got a fiduciary duty just to make money for our clients. Now, that's redefined in black and white as something that you should do. Not only that, investors are going to have to ask their clients, what are your preferences? What do you actually want? Do you have any sustainable development wishes? Do you want us to invest only in climate-friendly things, and so on? And then the investment firm is going to have to abide by those preferences. So, this could potentially make a big difference. But I'd like to ask the panel what they think and whether they're expecting a tangible change. Julia.
Yeah, I think that all the efforts that are taken by legislators to improve transparency in this area are definitely to be welcome. It's good when investors and investment managers disclose what they think about the scope and range of ESG risks and opportunities, why they're doing it and how they're doing it. So that is definitely a good step forward. With regard to some other legislative initiatives that we've seen already pass the European Parliament on the initiative of the European Commission, I have some reservations. One of those is designing a taxonomy of green or sustainable investments where the financing can go. I think that private market has already stepped up to do that, and we've seen a number of efforts in that direction. The climate bonds initiatives, for example, spent 3 years working via various working groups, and a lot of thought leadership went into that effort. They just recently adopted a new standard on forestry. Before that, there was a water standard, and so on and so forth, starting with the most obvious, the easiest industries like renewable energy, and then moving further into more complicated areas where more granular analysis is required. I don't think that any government initiative should duplicate something that the private market has already come up with. Equally, I don't think that the idea of government-endorsed benchmarks, indices, standards is going to fly, because again, this is a very labor-intensive effort. When it's done in a competitive environment, like index and companies, for example, competing with each other, trying to invent the best possible option, it is done much faster, more efficiently, and also once you have seen the great index invented today, incorporating all possible metrics reflecting the sustainability of investments, then the next day there will be another one, not replicating, probably
exceeding it.
Exceeding, yeah, the standards that have been seen before. So how you're going to replicate that dynamic in the government version, I don't know. I think that there is definitely scope for other actions to be taken, like disincentivizing certain activities and incentivizing certain activities in financial terms. By disincentivizing, I definitely mean the price of carbon to be put. So the European carbon market is not working. The price is not, by far, not reflecting the real cost of carbon emissions. And I think that the government should rather do something about that. In terms of incentivizing, again, one of the ideas that was kind of articulated, but it didn't go further, was the green supporting factor. And I think that given...
This is a lower bank capital risk weighting
Yes.
for green assets.
Yes, exactly. And given, again, so many private initiatives are already happening in the banking sector, where banks are lowering their interest rates to those borrowers who can demonstrate the green impacts being achieved on a gradual basis, these initiatives have to be incentivized. And there is, I can't see any other way of doing this, different from these green supporting sector.
So you think that would be a good idea?
I think that given this, again, we shouldn't lose sight of the lose sight of the science behind it. It's not an easy project. But I think that incorporating all the possible impacts that can be associated with green financing and that can be proved via reliable metrics and data, I think that it is a good idea. It could be a good idea.
Okay, thank you. Now, Zamir, you said at the beginning there was a lot of work to be done to start making the financial system sustainable. Do you think ultimately governments and regulators have got to drive that? And based on what you've seen the European authorities trying to do you think they're doing some of the right things, or?
No, I think so, certainly. Let me give you some. Regarding the earlier question, we were discussing about the appetite from the investors.
Yeah.
I just want to quote one of the recent studies by UN. They took a poll of what issue is more important to investors. And to a surprise, they came that many of the young investors, especially the millennials, when you ask them what are the key issues which are important to them, the sustainability, the poverty, climate, these things came very high on the agenda, which means the new generation, the new investors, the breed of investors which is coming are very sensitive to these issues. But at the same time, we have to be a bit careful that we are discussing these things in context of a developed country, a developed economy, but as soon as we go to the developing country, the awareness is not there. Their issues are different. But one of the challenges is that how to increase that awareness. Coming back to your question, I think there's quite a bit efforts going on. For example, last year, the World Bank issued a very nice policy paper called Sustainable Financial Sector, discussing about how to make the financial sector promote sustainability under the urbanization and infrastructure building and all these things. G20 has a mandate on giving the sustainable financial system, especially on the climate side. UN, actually, I mentioned to you about UN. This is their study on aligning the financial system to the sustainable development goal. So I think at a high level, in multilateral levels, at a G20 level, there is a kind of this thing is very high on agenda. Our challenge is how to penetrate that into our member countries, in the developing countries, in Africa or Asia. Over there, again, the awareness is not that much. But I think the good news is that when we talk about the sustainable development goals, within the Sustainable Development Goals, many of these individual goals out of 17 are very much related with sustainability. So I think once the member countries make a strong commitment to achieve that sustainability, I think it will boost kind of efforts. Another statistics that just in our member country, the IDB member country, 57 Muslim countries, the statistics are that in order to meet the SDGs, Sustainable Development Goals, we need about $1 trillion per year of financing. So imagine that out of 1 trillion, even 30% is geared towards sustainability, how much money we are talking about, and given the demand by the investors. So there's certainly, there are, these are factors which will be critical to develop this market. Our challenge is how to bring the policymaker, the regulator, the standard settings on board, commitment from them. Without this strong commitment, things are not going to move.
Okay, thank you. We're going to talk about the Sustainable Development Goals in a moment. But could I just now give the audience an opportunity? If you have any questions, I'd be very happy to take them. Anyone? Okay, well, we'll give you another chance in a moment. All right. Now, the UN Sustainable Development Goals, there are 17 of them. I expect everybody's heard of them. They range from things like clean environment, healthy seas, health and well-being, and so on. It's been remarkable how much attention they've grabbed. These are not the first time the international community have outlined goals for development, but this time it really seems to have been penetrating society and the corporate world. So I'd like to ask the panel how, we can all agree with these goals, they're all good things, but how do you actually translate that into something that people can invest in and actually systematically start to bring about through their financial and investing activity? So perhaps Alvaro, you'd like to have a go at that, and I'll come to Irene.
Yeah, thank you very much. So clearly, as you said, there are 17 Sustainable Development Goals. There are 169 targets, I think, or subcategories. So in that sense, obviously, it's easier at least to have a framework and some target sectors. Right now, as an example, we're putting together a facility just on food waste and loss in Africa. It's a private fund, so in that sense, it's just targeting 1 or 2 of all the targets. So when we go and reach out to investors and tell them exactly what we're doing, we just say, this is the Sustainable Development Goal, this is the subcategory. So in that sense, it's very targeted to their desires and to what they want. In that sense, it's helpful. There's also, as I mentioned before, once more, some...
So it's a sort of label, and you can say to the investor, this project or group of projects addresses this particular goal,
exactly.
And therefore you can sort of feel that you've helped with that.
Yeah, and I would say that's just a framework, and that's a label that helps address certain areas and certain factors to a certain extent in an easier way than the ESG before. Indeed, there's, as you know, there's in the private sector some SDG funds also going around, not as successful as ESG, because to me, once more, ESG has been a very successful story in the private sector. The weakest part, as I said before, is perhaps the social aspect, because the social aspect, one part many times comes from the government and also from the private sector. Usually what we think on the social side and the impact side is type of transactions that have very high costs that usually you need to really measure them in a very precise way in order to see that you have had that impact. And at the
You're talking about sort of small-scale impact investments where you're trying to sort of help people not go back to prison and things like that.
Well, or just lift them out of poverty.
Yeah.
I mean, so those type, and normally it's not like the other type of projects that MDBs look for where there's alternative financing. It's projects that you have to create many times. That's where the impact fund type of projects come. So as I was mentioning on the social side, I think ESG, the weakest part perhaps is the social aspect, but I think it has been a quite successful story in terms of environment and of governance.
Okay, thank you.
Just to follow up on that, I mean, I think the interesting thing about the Sustainable Development Goals is, as you said, that it brings in the private sector. So in 2015, when they were negotiated, it was very clear that this isn't just something for the public sector. And it's this impact has gone beyond the sort of social impact bonds, which are not actually bonds, they're more like pay-for-performance loans. And the Sustainable Development Goals provide a framework for investors, as I mentioned earlier. And the World Bank, we've been, we said labels are helpful, so we've been labeling our bonds as Sustainable Development Bonds just to communicate that that is what we do. And we've issued, on a reverse inquiry basis, some bonds that are linked to certain Sustainable Development Goals, like, for example, for a Swedish insurance company, Folksam, we issued a bond that was to raise awareness for 4 goals that they wanted to communicate to their stakeholders. And then others like focused on raising awareness for gender or for health. So that's something, they're very tangible. And some people say there's too many goals, but the good thing is that you will find what it is you want to support among those goals and use them as a way to measure impact.
Thank you. Irene, what are the Sustainable Development Goals meaning for the EIB, and is it going to sort of help your mission?
Yeah, I mean, definitely Sustainable Development Goals are embraced by EIB. We are seeing, a bit of a different approach here, because we think that SDGs, as the market is seeing them, they are very broad, they are vast, some of them are more concrete, I agree. But we are trying to make sure, let's say, that whenever we will report on SDGs, which is something that we are currently trying to map, there will be some clear connection on why we are reporting and what indicators we are using and why they are contributing to those SDG-specific goals. So we think that having SDGs is very good. It definitely conveys a message and it's useful for investors, but there needs to be some quantitative or qualitative reporting indicators so that investors can judge how substantial that contribution is. And if SDGs are also important in the sense that the EC action plan for the future of the regulation that is now being worked are embedded also will be embedded somehow in the regulation. What does this mean? This means that the EC plan is going, let's say, to promote a classification of activities and separating the activities with the objectives that are planning to be achieved. Let's say what each technology is doing and what it is useful for.
You're talking about the taxonomy.
Yes, but it's linked somehow to the SDGs because the taxonomy is embracing the SDGs at the base.
Yeah.
So let's say that EC plan is embracing both the Paris Agreement and the UN 2030 agenda with the SDGs. And I want to make this point because when I was listening a bit before to Julie, there we had a different view on the approach of the taxonomy. I mean, we do see that there are different initiatives in the market that are very useful, like the CBI that you mentioned, but there are also others in different regions. And what we are seeing is a bit that there is still some confusion on what different definitions of green are, and therefore this plan of the European Action Plan, what is going to come up with is with a table, so to say, of that can be used as a framework to compare different standards. So even if there will be a regulator that comes and says, you know, I want this screening criteria and this is what I want to use for the EU standard, this doesn't mean that there cannot be other standards somewhere else. So different standards will be able to coexist. Hopefully the clarity that this EU standard will bring is kind of a framework with clear definitions and the screening criteria, and then it will be up to each investor to take the decision of what is investable and what is not. So, you know, it's just the point that even if it's government-driven, you know, it's a bit the purpose of providing more clarity and for comparability.
So a strong defense of the idea of a taxonomy for the financial markets of what sustainable activity is there from Irene. Julia, you can come back on that if you want, or address this question about the Sustainable Development Goals and how does an investor start to tackle those?
Yeah. Yeah, that's what I actually want to do, to pick up on what Irene said and also what Alvaro said about the ESG assessments. I think that there is one big problem associated with the current way of thinking about SDGs as an investable idea, and the taxonomies as well, because they only look at sustainability from one perspective, from the perspective of the products that companies produce. But in addition to the use and the positive intentional impacts associated with the products that companies produce, there are also externalities or impacts associated with the production processes. Usually, the taxonomies do not look at that. And the investment products that have been designed to incorporate SDGs alignment of companies also only look at the products that companies produce. So if we think about it, there are two components of the overall impact. One is the component of do good with the products that you produce, so that the products actually fit people's needs and the environment's needs and the society's needs. But on the other hand, there is also a concept of do no harm with your production process, because sometimes there are negative externalities associated with it, be it carbon emissions, pollution, water consumption, or even human rights issues or labor conditions and labor rights. So I think that at the moment, correct me if I'm wrong, but the most complex and all-rounded assessment of companies from both perspectives, do good and do no harm, are the ESG scores, actually, because they look at both. They look at what companies do and how they do that. And also, another thing is that when you just look at the impacts associated with products, usually the universe of bonds or stocks that you can, connect with these impacts is relatively small, which is why the portfolios of impact funds, either in fixed income or in equities, are very, very small, and the funds themselves are quite small because the opportunity to identify these positive impacts is limited. But if you base your judgment on this complex ESG assessment, provided that you trust your data provider and research provider, obviously, then you can actually deal with the whole universe of listed bonds, the whole universe of listed stocks, which makes, first of all, your portfolio much more diversified. And you know that many investors are not comfortable with the idea of tracking error to the standard benchmarks. So the tracking error in this case will be minimal. But also the overall impacts with this type of universe are going to be multiplied by several orders.
Okay, thank you.
I know we're running out of time, but I just want to add one thing. You mentioned ESG scores. I think potential for development of ESG scores is to cover the intentional impact, which they currently completely ignore. So they just look at the effect of the products, like you say, do good or do harm, but they don't consider the intentional positive impact that, for example, the multilateral development banks are designed to do. So I think that's something for the future. Maybe the next panel we can talk about that.
I think, well, Julia maybe disagrees with you, but I think perhaps we are short of time. Do we have any questions from anybody? Okay. Maybe you're all shy because I asked you to put your hands up, but whatever. Let me just finish by, I'm just going to ask each member of the panel to suggest one thing that they think would help this process, which I think we all agree needs to happen, of making the financial system into the one that we need to achieve sustainable development. So just one suggestion, perhaps, from each member. Zamir, would you like to go first?
Well, I think coming with my experience of multilaterals, my thing is that I think that there need to be quite collaboration efforts at a global level with G20, with UN, with MDBs, and many other stakeholders. They need to start increasing the awareness about it, educating people, educating investors, educating policymakers in their constituencies, in their member countries. I think that's certainly process has started, but I think that needs a partner from the private sector to come on board and make sure that these efforts are implemented, or these recommendations are implemented, so that we can achieve our objectives of creating a sustainable financial system.
Thank you.
I think better metrics should be developed around, again, measuring impacts of each and every bond, not just green bonds, not just social labeled bonds. The universe of impacts is much, much bigger, but we definitely need these metrics.
Yep. Thank you very much. That's a very good point, that every investment has an impact. Whether it's a good impact or a bad one is there to be judged, but there's no investment without impact. Alvaro.
I would agree on the collaboration between private and public sector, designing the right incentives and to create the positive externalities that we're looking for.
And by positive externalities, you mean?
That would be another panel, I think.
All right. Heike.
All good points. I would just say get engaged and don't just tick the boxes.
All right.
And I would say completion of the taxonomy at the European level, which would drive the EU standard label, and this would help not only investors to channel more funds to sustainability projects, but also for regulators to take the right decisions they are expecting for in terms of impact of favoring one sector versus the other. And I think that at the point in time when we are able to reap the regulatory benefits, that can definitely change the way the capital is allocated to green projects.
So basically agreeing what is sustainable and how sustainable it is, and that way investors can channel capital and regulators can design incentives to support that. Okay, I think that's a great note on which to end. Thank you all very much for your attention. I hope we've sparked some thoughts for further action. And please join me in thanking my excellent panel for being with us here today.